And welcome once again to the Smart Money, Dumb Money Show. I am your host, as usual, Keith Richards. And every once in a while, as you guys know, on my videos, I do a guest interview. And I gotta say, I've interviewed some really amazing people, and go through the archives and you'll see some people that you will recognize. But this man today is, I think, one of the most significant people I've interviewed yet. And I'll do a quick introduction, although those who read my blog and watch these videos with any regularity are familiar with his name. It's Larry McDonald, and Larry McDonald runs Bear Traps. I was an early subscriber to his research, and I was just saying to Larry a minute ago, I said, listen, you may think I'm gushing when I give you the intro, but there are three big influences in my career. And I've been in this business since 1990. Actually, I was started in 89, so it's really like 35 years, but 34 years licensed. And so I've been around a bit, and I've had lots of good people in my life, but that have helped me and taught me. But I've had three guys. The first guy that introduced me to technical analysis was my first influence. The second guy was Ralph Acampora, who is probably the single best technical analyst in the world. And I was privileged to stay with him for several days and one-on-one have lunches and whatnot. He knows me, and I'm one of the, I feel very privileged with that. And the third is this man here, Larry McDonald. Larry literally has turned my way of thinking around in the past 6 or so years that I've subscribed to his research, 6 or 7 years. And I just am so thrilled to introduce him. I came across his book originally. It was called A Colossal Failure of Common Sense, and it describes his days in Lehman Brothers during the Great Collapse. And Larry was a distressed debt trader, and he was like one of the top guys in the world, all in an atmosphere and a firm that was literally collapsing around him. And it's just like, the story is amazing. If you want to read an entertaining read, read that book. And his second book, most recently, and I have talked about it on the blog a couple times, is this one here, and it's called How to Listen When Markets Speak. And I just finished audio reading it, and now I'm going to read it because it's so good. And by the way, Larry also, if a lot of you guys have read my book, Smart Money, Dumb Money, Larry was kind enough to contribute a little bit to that book through a conversation that we had over email. So Larry, welcome to the show. I'm done gushing.
Thank you, Keith. Keith, we go way back, buddy, and I really appreciate you. And I tell as a former Lehman trader, I was a trader at Lehman, and over a Sunday brunch, I tell my wife once a month, if we sell 1 million books, we'll break even on our Lehman stock.
That's great. Well, I don't know if I'll help you sell 1 million. I've bought a few for some of my clients and sent them out. So I want to get started, Larry, because some of the stuff that I've been talking about in my blog fits in and has been amplified by the research that I read through your Bear Traps report. And by the way, there are financial advisors that watch this video, and I heartily recommend that if you buy research, Bear Traps report, look it up. It's actually the best research. Maybe I shouldn't tell my competitors, but it's the best research I have. And I have lots of research. I get Rosenberg and all kinds of stuff, but it's good stuff. And one of the things that I've been talking about is the cyclical nature of the commodities markets. And my belief has been, from a pure cyclical point of view, we're going to see a resurgence in commodities. We're starting to actually see that. And Larry tells me the reasons why that. I'm a technical guy. I'm only interested in price, but he talks about the background. So I want to start off with the energy demand, and you guys have heard me talk about this in the videos and blogs. And coming from, believe it or not, the green energy and crypto and data storage and all that sort of stuff. Larry's the one that gave me the data on this. So I'd really like to, Larry, if you could start off and give your overtake of why energy demand is going to grow and how we're going to fill it.
Well, thank you, Keith. And, there's no I in team. So I think my blessing is, after Lehman failed, I did 140 speeches in 16 countries, and I met so many talented people around the world. And so we created this Bloomberg chat behind me. And so if you picture in your mind a theater with, say, 650 people in the theater, in 20 countries. So 650 people in the theater, 20 countries, and they're all institutional investors. So they're at the big shops, the Fidelities, the Hendersons, the hedge funds, the mutual funds. And what we do is there's about 30 to 40 people in that theater that actually get on stage and have a conversation. And so what we're really doing is we're crowdsourcing intelligence, and that's how we produce the research. So what we do is, like, if Goldman comes over with a report on energy demand, or JP Morgan, we'll talk about some of these trends in the chat, and we'll kind of develop, okay, where is the strong piece of research? What do the buy side investors, what does a veteran hedge fund manager or veteran mutual fund manager, what are they saying about the research? And then, or the topic, whether it be, like you said, artificial intelligence impact on, say, natural gas, or nuclear power and small modular plants, or small modular production of nuclear power that's going to be maybe next to a data center. So these types of themes, we gather that intelligence from the chat, and so I'm kind of an ambassador to that, and I appreciate all the accolades, but it's really, I owe so much to the people behind me, and thank you for all the acknowledgments to them. So the point that we're making, like the big picture, is we've taken 5 million jobs out of the United States. I think of like the Davos crowd in Switzerland, and we have the Davos meeting. You've got the U.S. Davos people, the European Davos. They mean well, and they're really globalist, and they wanted to raise the standard of living globally. And so what we've done is we've decimated the Rust Belt. We've taken 5 million jobs out of the U.S. We've pushed them around the world, and we've raised that standard of living globally dramatically. And but at the same time, we're suppressing the supply of energy through a whole bunch of ESG forces and a whole bunch of different forces, which we can get into. So if you think of like a young person in India that works at a call center, he's making 10 to 20 to 50 times more than his great grandparents. And so we're seeing this incredible sustainable demand for energy from the developing world. It's kind of like, if you think of like Frankenstein, like you're talking about global central planners that meant well, but they're really on a course that they've created a real energy crisis, probably 2025, 26, because of ESG, and because of a lot of CFOs and energy companies were burnt for a whole bunch of different regulatory reasons and a whole bunch of different overproduction reasons from the last commodity crisis. All this came together, and so we're suppressing the supply of energy. At the same time, we're dramatically juicing the demand. And I think the last big picture point is, if you think of like 2010 to 2014, and you think of the investment track that we were on, the planet Earth, the energy, oil and gas, uranium, your metals, all those key strategic metals, uranium mining, all of this that you need for energy. You need the metals, you need key metals for windmills, right? And those are very rare earths that the United States just literally, we have less and less and less control of these key strategic minerals and oil and gas. And so that investment path from, say, 2010 to 2014, if you move it forward to today, we're essentially $3 trillion in the hole. And the global population over the last 10 years is up 900 million people. So we've got 900 million more people, but we're about 3 trillion in the hole in terms of investments. And so that's what really sets up the big picture theme for the book.
Yeah, you mentioned in the book, Larry, it was through your conversations. And by the way, what's one of the kind of cool things about your book is that I think I sent Tatiana, your assistant, a note. I said, a lot of the financial books out there these days, you fall asleep, a quarter of the way through them. But your book keeps you engaged, because it's, 1 minute you're in an oyster bar talking to somebody, and the next minute you're going down an elevator and you're talking to these famous hedge fund managers and whatnot, or traveling out to Brazil and meeting, great managers and politicians and whatnot. And it keeps you engaged. But yeah, you talked about that, the probability of these goals of becoming carbon neutral in the time frame that the kind of more woke politicians are talking about is going to be stretched way beyond their timelines. And so maybe you could speak to that a moment.
Okay, so one of the people, so behind me we have that, like I said, the set chat with the institutions, and over the last like 3 weeks, more and more people have been making this point. BP kind of reverse course, British Petroleum, in terms of their investment path, and they admitted that they need to kind of ramp up investments. So that's kind of a classic thing, because over the last year and a half, well, I should say the last 5 years, they've been bragging about kind of investing more toward green initiatives and less toward oil and gas initiatives. And so they've kind of, in the last 3 weeks, they've admitted that that path is incorrect, and they're going to have to adjust that. So that's a big point. And one of the main points people are making in the chat, and people are starting to hear about, I started to hear about this maybe 2 months ago in terms of it really becoming a problem. But if you look at hybrid sales, hybrids versus EVs. So think of like hybrids. They obviously consume both electricity and fossil fuels, and they also have things like the catalytic converter is very, very important for what we call platinum and palladium demand.
Yeah.
And so if your EV penetration, was supposed to be here, right, but it's actually going to be here, so we wrote this in the book. My point is, we had some of these predictions in the book, but we're starting to see the big automakers admit that they're shifting more. The demand for hybrids is exploding because of all of the problems of actually, like you said before, getting this EV system up and running, and that whole, whether it be cold winters in Toronto, or whether it be small fender benders that blow up or ruin a very expensive battery. A very tiny fender bender can really ruin an electric vehicle. And so there's all these unintended consequences that nobody's really planning on that are pushing out the EV penetration. So if the EV penetration formula is pushed out, say, another 10 years in terms of that track of EVs where they thought the market would be, then that's going to create like you said, we need that bridge of oil and gas and uranium to get through to the other side. So carbon neutral 2050 is really more like carbon neutral 2100.
Yeah, and I remember that was in the book, and I fully agree. I mean, one of the people I actually interviewed is Lauren Gunter, who you may not be familiar with, but he's a pretty well-known reporter with the National Post here in Canada. And he was talking about, there's all the lack of reality behind EVs and why they're all ending up in the used car sales lots because of, they don't go as far. They don't go as far in the winter. The batteries get 30% less mileage by the time they're 5 years old, and all these things. So everybody's kind of been disillusioned and trashing them. So there's even the technology in the EVs themselves is not there, for massive adaptation to the product. But whatever the case, so let's move on, because I tell you, like, I was asking.
But keep in mind that. But my point there is the trade there is like platinum and palladium. They're really cheap relative to gold, like the cheapest we've ever seen in terms of platinum. And so, if that penetration is on a much slower track, those metals were really annihilated the last 5 years because of the expected EV penetration, right? And so if the EV penetration is slower and hybrids expand, that's potentially, for our viewers, that's a really bullish trade there, just on that little spot. And there's so many different trades that come out of the book and can come out of this conversation.
Yeah, no, it's absolutely. Actually, I think in our aggressive strategy, we have either platinum or palladium. I'm sorry, I don't remember which one, but it was on that concept. They're pretty oversold. Okay, so I want to get, you mentioned again, I've got a lot of talking points here, and I maybe can just rip through them. But the one is you were mentioning like the international policies and the effect on, like you talk about Ukraine hit hit Russia, and all these different things, oil spiked, blah, blah, blah. So talk a little bit about maybe the international scene and where, how that affects us as investors.
Okay, so when you write a book or do a speech, right, you want to have a formula of good storytelling, good facts, humor. And so it's like a recipe. You need to have the right ingredients when you write a book or a speech, because if it's too much information, it'll put the audience, to sleep.
Sweet.
If there's too much storytelling and not enough facts, then, you lose credibility. So we worked really hard on creating a balance in the book. And so one of the things, I was fortunate enough, I did a speech at the National Bank of Abu Dhabi, and I met with James Baker, Nicolas Sarkozy, Neil Ferguson. I mean, Neil Ferguson's become a good friend over the years. I love him, probably the best financial or just historian out there. And so these are really important mentors to me. And so Ferguson and Baker, James Baker was the Secretary of Treasury and the Secretary of State with Reagan. And I think he also participated. He was a part of the Bush administration as well. But when we were in Abu Dhabi, they really opened my eyes to this whole multipolar world potential. And then over the years, Neil Ferguson really opened my eyes to it, like in 2020. But a unipolar world, you think of like 1982 to say 2000. Each year, the supply chains got smoother and smoother and smoother and smoother. The U.S. became a more dominant and dominant. Obviously we had the fall of the Soviet Union, and the U.S. became a much bigger player on the global stage, a much bigger force. NATO expansion. It got to the point where, the neocons in Washington really kept pushing and pushing. And think how far NATO's expanded, right? Since the 60s or 70s, and so NATO got bigger and bigger, and so we kept pushing Putin into this little corner, and now we're in a far more multipolar world, where in a unipolar world you have one country that's kind of the dominant force of trade, of supply chains. In a unipolar world, that's the case, where you typically have very deflationary forces in a unipolar world. That's one country that really is controlling the whole global system, and it's very deflationary. But when you move toward a multipolar world, where you've got global conflicts, where the U.S., our defense budget's now going to be stressed the next 10 years because of the interest on the debt is approaching $1.4 trillion if we go higher for longer. And so for a whole bunch of different reasons, whether it be sanctions, whether it be the way the global conflicts that have developed through the Middle East or in the Ukraine, it's supply chains. There's a whole bunch of forces that are much more inflationary. And with global conflicts, you obviously have a problem with energy, energy transportation. And so all of this creates like this undertone of support for higher prices. And so in a unipolar world, you need a totally different portfolio. And so I think what's happened is the intoxication of, say, the Mag 7 and what we call financial assets from the last 20 years, you really needed a deflationary portfolio. And so everybody was kind of like brainwashed into this. And but if you go into a multipolar world, you really want to have, it's okay to have some components of that, say those more, I guess you say technology is okay, but the percentage of the percentage of metals, oil and gas, uranium, in industrials, these percentage in the market, we get down to like 13%. 13% of the market within the last year was industrials, oil and gas, metals, and uranium. And in 1980, that number was up there 50% in that multipolar world. And so we really are kind of underweight the potential portfolio that you need for that new decade. That's going to be a lot different than the 2010 to 20 portfolio is a lot different than the 2020 to 2040 portfolio.
Yeah, this is like I was saying, Larry, like, as a technical guy, I see this cycle of the S&P versus the GSCI commodity index, and so there's roughly 10, 12 years here, in the cycles, and then here you are telling us why, like the charts are telling me that we ought to see a return to commodities, and yeah, sector rotation, right? It's time. You're already seeing it, and so yeah, you mentioned in our talking notes, you mentioned Nvidia. I don't know if you want to, if we've covered that enough, if you want to talk a little bit more about that, but it's certainly, they came out with a bang out earnings report. Everybody's fallen in love all over again, but there's really if it really is, I mentioned in a blog the other day, I said, if Nvidia, I said, is AI a bubble? It was the name of my blog. I said, if Nvidia is really, everything they say it is the best stock you can buy in the market, then it better be the best stock on the market. It better have predictable earnings and all of those other things. And it's being priced on revenue. I don't even know if it's being priced on earnings, because that would be too extreme. So anyways, do you want to address?
Yeah, no, I think that's important, because it's the story of the week, the month, and over the last 18 months, it's gone from 1% of the S&P composition to 5%. 1% of S&P composition to 5%. And if you think of like how the evils of passive investing, we get into this in the book, but this is a company that is, first of all, it's a sector that is extremely volatile. It's very cyclical. And there's a lot of booms and busts in semiconductors for a whole bunch of different reasons, which we can get into. But you just have so many people that are intoxicated with AI, and they're not looking at, it's just like 99, 2000. They're not looking under the surface. Everybody's looking at JDS, Uniphase, Cisco. They're not looking at like, where are the real trades, like natural gas, like you said, if you believe the Nvidia growth trajectory, we're going to need a ton of more cheaper electricity that comes from oil and gas, uranium, and we're going to need a whole bunch of new technologies, a whole bunch of new what we call utility type companies that are going to go from very 2% growth to maybe 10% growth. That's what Buffett said in the annual meeting. Duke Energy or Dominion, you might have companies that have been growing in 1 to 3% a year, that to fulfill this artificial intelligence dream, very old-fashioned type companies, if they're in the right parts of the United States and closer to those data centers, you could see just tremendous growth, tremendous pricing power. And everybody's focused on Nvidia. Nvidia is 81% above its 200-day moving average, right? Yeah. Think about that. It's a $2.7 trillion company that's 80% above its 200-day moving average. The most Apple ever got was about 63%. The most Microsoft ever got above its 200-day was 34, 35%. So this is a very dangerous situation. There's, Keith, there's $34 trillion that's tied to passive strategies. It's quite evil. I mean, every time a company comes into the S&P, look at Lululemon, the people get the inside information, or they get on some type of information group that figures out, okay, which companies are going to go into the S&P, whether it be Super Microcomputer, Uber, or Lululemon. These are the last three examples. The stocks go up 100, 200, 300% into inclusion. Then all of these copycat passive tracking funds have to buy these stocks after the jump. It's insane. It's insanity. And so that's the whole point, is there's so much passive money that now owns this extremely dangerous volatile stock in Nvidia. And so, buckle up. It's just going to basically create more volatility for the market.
Yeah, that's actually, you just rewrote my blog from 3 days ago, the AI bubble, because I was talking about how, everybody buys ETFs that are index ETFs, and guess what? Nvidia's just gone here, and therefore the ETF has to buy it. And it's like this, which came first, chicken or egg, right? It's
right.
Like, it's, and also on the power grid thing, another quick thing.
And in my book, I sit down with David Einhorn, billionaire investor, Greenlight Capital. And I'll just say, like, to end this little part of the conversation, it's like he's on these conference calls, Keith. Nobody's on the calls. Like fundamental investors that actually ask the tough questions of management teams, nobody's home because everything's passive. And you've got State Street, Vanguard, and BlackRock that are the large shareholders, and there's no real accountability from management teams. And so I think this is all going to really unwind over the next 4 or 5 years, where active managers are going to take a much bigger seat at the table once this reverses.
Yeah. I mean, to your point about the 200-day moving average, I get worried when it's like 25% over the 200. Anyway, so yeah, it's amazing. And actually, let's talk about this whole ETF thing, because this is another, thing that I think a lot of people aren't aware. Well, for example, that they by owning that so-called safe, just buy the market and wake up in 10 years and you'll be fine program, they don't even know what they own and the volatility that could ensue because of what ETFs are doing. So is there anything else you wanted to address on the ETF issue before we move on?
Well, the one thing we get into very quickly is like the vol suppression, where if you have so much passive money that's coming in, and then you've got so many people that are selling volatility because for a whole bunch of different reasons. The vol sellers are very, there's like a pack of piranhas, and they will try to manipulate volatility down. And so you have this like vol suppression that keeps building and building and building and building. And what happens is there's one event that really unwinds it. And so what we've had since 2018, we get a lot of vol suppression, then like you saw Volmageddon, and then we saw COVID. And so then we've had 3 vol events since 2018, Volmageddon, COVID, and then obviously the Ukraine war, and actually a small one with obviously the war in Israel, where the market gets caught offsides. All these vol sellers and these quants, they're buying, short-term options, and they're suppressing volatility. And then, so the bottom line is when you see the VIX get into that, 12, 13 handle, it's crazy. You've made money by getting long volatility. If you look back the last 4 or 5 years, every time we're down there, it may stay down there for a little bit, but we typically we've got some very tradable moves. And so right now, I think vol is still pretty cheap relative to, kind of what's happening in the next 6 months with the presidential election, this conflicts in the world, the global conflicts. And so vol looks very cheap relative to some of the risks.
Yeah, vol often spikes coming into an election. That's been one of those historic patterns. So yeah, and
Right.
I agree. Like, it's funny because we run not to your level of sophistication, Larry, but we run a quant screen just trying to give us once a month. We just do it once a month, a picture of where the risk might be on the market, and we give it a scale 0 to 8. So 0 is run for the hills, buy canned beans, live in a bomb shelter, and 8 is back up the truck and mortgage your house and buy more stocks. So one of the factors is the VIX, and it's just one factor out of 11 factors that I use. But it's amazing. Like if vol can stay down there at 12 or below, it has historically, and it often does clusters. But when it's down there, where it has been lately, and it stays there for too long, then you have a setup for, like you're talking about, one of those COVID, like, to the moon events, or maybe not so high, but at least back to 20, and so we'll have to see if that happens. But I got to say it's probable, not possible. It's more probable.
Well, especially with the way, what people are talking about behind me is the way the Transports Act, consumer discretionary transports in the banks, like the super regional banks, are showing a lot of stress. Like the underperformance of some of these big, like look at U.S. Bancorp versus the S&P. It's the 5th largest bank in the United States. Then you look at the consumer discretionary, down 2 to 3% on the year. These are supposed to be consumer discretionary. What happened to the consumer? I thought this was a raging strong economy, and the transports are under. So what we do is we measure in the book we talk about this, and I know you do this, but we measure the breadth of the underperformance. And when those things get this, when they underperform by this much, it makes the whole volatility bet that much. That makes the risk reward so much more attractive, and it makes makes you, I think it also helps you figure out whether or not you're pretty close. I think we're pretty close to a big vol move.
Yeah. Well, we keep to your point. We raised cash again a couple days ago. We just keep, and I tell you, if we see 5,200 crack, that's one of our rules. We just get out. We'll be getting out again. Okay, so we talked about the rare earths and stuff, but one of the points that I wanted to ask you, because as I said, we have some talking points we put together before this, but this is the one that I really need some input on this, because this is like, we can talk about vol all day long and I'm familiar with it, but this one I'm not, is you talk about a potential banking crisis. And really, could you talk to that? Could you speak to that? Because I'm fascinated in your thoughts here.
Well, what happens is when you get in an election year, you have a lot of positive messaging from the White House, whether it be Republican or Democrat. I'm not picking on Democrats, not picking on Republicans. It's a historical fact that in election years, like 2008, for example, if you go back to 2008, and I remember I wrote the book about Lehman Brothers, so I researched this intimately and meticulously. The Bush administration was trying to help McCain, and they were talking up every single good part of the economy, the consumer. Every piece of data was viewed as like, wow, this is great. Oil prices in the spring of 2008 were $140 a barrel. The economy looked really strong. And so they spun it that way. And meanwhile, the banking system was showing a lot of weakness under the surface. Everybody ignored it. I'm not saying this is 2008, but it's the same exact thing today. Like, everybody's looking at, okay, strong economy, labor market. But if you look at New York Community Bank, or if you look at Bank of the Ozarks, or if you look at BMO overnight, like I guess yesterday, Bank of Montreal, all these signals are pointing toward what risk people do. And when people are in a bad trade, they go into the risk meetings, and I've been in this situation at, say, Lehman Brothers, and they say, okay, hopefully we're going to get some rate cuts. This is what they've been saying over the last year and a half. When they go into these risk meetings at banks, they're like, okay, give us another quarter or two before we have to mark this stuff down, because I think we're going to get some rate cuts. And once we get those rate cuts, we'll be in a much better spot. Because remember, we kept interest rates at 1% or below, or zero, for over a decade. And there's at least $3.5 trillion of commercial real estate loans on the bank balance sheets. So everybody wants to pretend that we didn't distort the cost of capital for literally 12 to 15 years, which is disgusting, right? We distorted the cost of capital. And so if there's $3.5 trillion of these loans, they're all priced for a fantasy world of, say, 1% interest rates. There's hundreds and hundreds of billions of dollars of losses that are sitting on bank balance sheets, and the truth is coming out one drop at a time. Every day there's a new one, every single day. We had 2 this week, and we had, I think it's the Bank of the Ozarks is down, and it sounds like a funny name, but they actually have lots of commercial real estate in some big cities across in the West Coast and different parts of the Midwest. And so that situation with New York Community Bank, it's the same thing. Situation with Bank of Montreal, BMO, and so the truth's just bleeding out. And that's why if you look at the performance of the KBW versus the S&P, or the KRE versus the S&P, it's financial crisis type stuff. It's that kind of crazy. If you look at Zions, US Bancorp, and say Comerica, these are 3 huge, these aren't little regional banks. These are large super regionals that are underperforming the S&P since the first quarter of 2023 by like 25 to 50%. And whenever you see that, you just want to be like, okay, that's telling you something. The beast inside the market sees this. And there's no question we have a financial crisis coming at us in corporates next year, the whole refinancing, but more so commercial real estate. But it's not a Lehman. It's just a big refinancing crisis where a lot of bad loans are going to have to get worked out. But right now, it's been extend and pretend but the longer you go higher for longer, as one of the guys said this in the chat this morning, it's extend the pretend for like the last year, right? But the longer you go higher for longer, the more you actually bring out the truth of these bad loans, and you'll see it from companies' earnings reports in the months ahead.
Yeah, and I know, well, we share a belief that, the future ain't what it used to be when it comes to inflation. And, you've used the word and I've used the word. I even actually had one of the hosts that I speak on BNN once a month. I go on their television show. Some of the people that I communicate with, she's quite bright, but she said to me, well, officially we're not in stagflation because it doesn't fit the definition. But I said, well, I don't care what you want to call it. It looks like it, because inflation.
Well,
really
what's funny about that is Powell said in the last meeting, he said, I don't see the stag or the inflation, right?
Yeah.
So, because what he did was he took like the 1970s definition, which was like 10% unemployment,
Yeah.
and like 7% inflation. Like, okay, that's the extreme definition. But then Jamie Dimon this week is basically warning about this is the CEO of JP Morgan is basically calling, he's not directly, but if you just listen to what Jamie Dimon said and you listen to what Powell said, Jamie Dimon is calling him out publicly, not in his face, not calling his name out, but he's saying a very opposite thing than Powell saying.
And that's, yeah, because so we're Canadian, eh? I had to throw an A in there. So as Canadians, we're looking at what's happening here, and our unemployment is terrible. All about Trudeau, and we can go on about that guy, but the unemployment situation is not good. Our business environment, our productivity is like the lowest in the world. So we're more in Canada, we're more facing a legitimate, you want to call it a slowdown, you want to call it a recession, or whatever you want to call it. So our inflation is actually falling. It's not because they've done good work with the monetary policies, because basically they've crushed the economy through various policies, and now we're seeing a slowing. Well, in the States, it's the opposite. It's you've got kind of higher for longer, like you've been saying, and that doesn't allow the U.S. to lower its rates. Which, by the way, if that happens in U.S. keeps their rates relatively kind of stable, and we lower rates, we're going to see our loonie get crushed, which is interesting. But there's another factor that you mentioned, and I wanted to finish up with this one last question. Is that you are calling for a higher, not high, but higher inflation in the US for longer. And part of that is based on whether you elect Trump or you elect Biden. They're both kind of protectionist, and that's another factor that I know you've been looking at. So maybe you could sort of speak to that and more on why your inflation thesis is fairly, is worth looking at.
Okay, yes. Yeah, so Trump, both Druckenmiller and Stan Druckenmiller, famous investor, Bill Gross in the last couple of weeks, they both said the same thing, that Trump is, kind of a closet MMT, modern monetary theory, probably more. Trump would try to gas the economy to get us out of this mess, because the only way you get out of a $35 trillion debt hole is through financial repression. And financial repression, we talk about this in the book. I sit down with Mark Chabal. Mark Chabal is one of the most brilliant investors I've ever met. He worked in Moore Capital for years. He was on the original Louis Bacon team. But Mark gets into, like, if you need to keep the interest rates below the rate of inflation. So interest rates here, inflation here, and that's how you can monetize the debt. And the only way out of a $35 trillion debt hole is by financial repression, or what we call debt jubilee. And there's been many civilizations going back the last 3,000, at least 3,000 to 4,000 years, where we've had financial resets and big defaults. And we've seen this with Argentina. I've seen this with many civilizations where there's just a debt jubilee. And so the US isn't going to have a debt jubilee, but the only way out of that kind of hole is if you can keep interest rates below the rate of inflation. And so they won't tell you this, but when you really dig into people, you talk to people on the Hill, you talk to people, in private dinners around New York, around the world, it's pretty clear that they're going to reset the inflation target from the Fed from 2 to 3%. And there's a big, very progressive group in the Fed that, they want to cut rates now. Elizabeth Warren wants to cut rates now. All the progressives want to cut rates. They'd rather deal with inflation than unemployment. And so that whole psychology is coming out. Trump, if he spent money aggressively on the fiscal side, that would ramp up the deficit. But if that created an economic boom, somehow you can get out of that. But MMT's never been, it's a theory, it's never been proven. And we did try MMT during the COVID debacle, right? That was clearly MMT. We had back-to-back deficits of almost back-to-back 3 trillion per year of deficit spending, and then GDP went up, and now it's come way back down. So the point I make in the book is that Lehman Brothers, the fiscal and monetary response to Lehman, and this gets into inflation sustainability, the fiscal and monetary response to Lehman was 4 trillion. But in 2010 to 2014, the Republicans took Congress and they took the Senate, and then we had a vicious austerity regime in the United States. So we had a $4 trillion fiscal and monetary response to the COVID crisis, and we had a vicious austerity regime in the United States and in Europe with Greece and the whole Brexit. So it's a lot of deflationary issues. Here, the fiscal and monetary response to COVID and the banking crisis of right now, we've got New York Community Bank, Signature, everybody knows about Silicon Valley Bank. And so though that banking crisis plus COVID was $16 trillion fiscal and monetary, 16 trillion. That's fiscal spending and monetary spending, monetary balance sheet expansion. And so that, and guess what? On the heels of that, we see no, I talked to Mick Mulvaney. We did a call with Mick and some of our clients. Mick was head of the OMB, talked to people on the Hill. There's no motivation for austerity now. And so that's where you just have a totally different environment, plus the multipolar world, the fiscal overdose, plus the multipolar world, and the supply chains that are just broken. And so all of that gets you into an inflation regime that normalizes at 3 to 4% instead of 1 to 2, 3 to 4 instead of 1 to 2. And everybody's portfolio is set up for that previous regime of 1 to 2% inflation.
Hence the commodity cycle. We've circled back.
Exactly.
So
commodity cycle, if we go into financial repression, like we haven't really done it yet. Like we had a little bit of financial repression in 2022. We had very high inflation, but now if they really change that inflation target to 3% and it hangs out higher, and then they can get rates lower through QE, that'll be, we'll be off to a roaring commodity.
Yeah, and that actually long-term inflation's been like 3%. If you look at really long periods, it's kind of been an average. So, well, listen, Larry, I've probably taken too much of your time, and I know you're a busy guy, and I need you to keep researching to keep me with good ideas so I make my clients money. So, thank you so much for coming. Like literally, I'm so thrilled to have you on today, and you are, like I said, a major influence in my business. So we just feel blessed at Valuetrend that we know you, and we're part of your circle.
Well, great, and let's do something in Canada. We'll be up. We have speeches in Montreal, Toronto, and Calgary. This, I think between late July and early August, so we'll be up there. So hopefully we'll get together.
Hey, I'd love that. That'd be great. We're pretty close to Toronto in my office, so that'd be great.
Okay.
Well, Larry, thanks again, and I'll look forward to talking to you in the future.
Okay, thanks, Keith.
Okay, thanks.